Okay, now how do I share this with everyone without jeopardizing your, like, put a password on it or something, or?
Oh, yeah, it's probably going to ask for a password.
So then it's your regular meeting room, but I give them a password, right?
It might not even ask for a password.
But it's your regular meeting.
Bullshit.
But it's your regular meeting room?
Yeah, that's the only thing you can do right now.
Okay, so I'll do.
See, now I'm able to get into it, which is interesting. When I hit edit.
Yeah.
Hold on. Well, I know you gotta go, but it looks like.
All right, so I just give everyone your Zoom meeting room, but I don't want, I guess they can access it anytime though, right? I mean.
Did you already do it?
No. Are you trying to figure something out?
Yeah, just give me 1 more minute.
All right.
This is bullshit, dude. I can't believe they did that. And they don't even communicate with their clients.
Yeah.
Yeah, it's not letting me in. That's amazing. And they actually cut you out. They didn't even let you finish your billing cycle.
That's fucked up. All right, so I'm gonna text. I'm gonna give this to Jay, and then I guess I need a phone. The phone number to. No, wrong thing.
Yeah, I can give you the. Here, I'll text you, or I'm gonna email you.
No, I've got it. I got it. Join by phone. Meetup, hang up. Yeah.
Yeah, so you see the password is mastermind to join that one.
All right. All right.
All right. Good luck.
Thanks. And then to have everyone on silent when they join, do I do that automatically?
To do what?
Have everyone sign in as mute.
No one needs to sign in as me.
I know, but whenever someone logs in, I could just have them automatically go to mute, right? Or.
Oh, there's a function where if you click on participants when they're clicking in, and then there's a box that'll open up, and there'll be some options in the bottom right, and then there'll be all those options right there.
All right, thanks.
Yep. All right.
Bye-bye. Hey, Robbie.
Yeah. Oh, hey, Gary. Can you hear me okay on here?
Robbie, can you hear me?
Yeah. Yeah. Can you hear me? Hello? Can't hear me?
I'm not hearing you.
But I hear you. I hear you. Where's my options? Of course, no. It says it's working.
All right.
Hello?
Yeah.
Oh, it's working?
It was on my end.
Oh, okay. So this is not the original Zoom link?
No, we had I did it as a webinar and Zoom kind of fucked things up. We've had some problems. So I switched to this.
I assume Jay's doing that. I just texted him and he was like, oh, I'm having problems. So I assume he must have got you.
Yeah, he just needs to post it to everyone that said they were coming.
Yeah.
I got it.
Oh, yeah, I see it.
We had a large contingency that said they wanted to do it. That said they were coming.
Oh, really?
We had like 70 people, I think.
On the meetup, yeah, I saw it was like 77 people. But they might be clicking the link like we were just doing.
Yeah. Yeah.
Oh, there's Jay. Hey, Jay.
Jay.
Yeah. Hey, Gary, can you hear me?
Yeah.
I just posted it.
All right, thanks. Do you guys, well, you're not, you don't have access to the, who's trying to come in. So I'll just keep an eye on that.
Oh, I see.
It has me accept everyone, but I'll just keep looking at it.
Can't make it automatic, huh?
Let me see if I can.
You can.
Do you know how to do that, Robbie?
I don't know. I think if you're the host, you have different options, and I think it's at the bottom of the participant window or something.
All right, you have disabled the waiting room. Okay.
Oh, there we go.
All right.
Oh, there's people.
Yep. Hey guys, how's everyone doing tonight?
Hey, how's it going?
All right. We had a big RSVP list, so we'll give it a few minutes. We had to switch to this. Zoom was acting a little funny. Lots of users.
Hi, guys.
Hey David, how are you?
Good. How are you?
All right.
Nice house.
I know.
Thank you. You guys all doing good?
Yeah.
Yeah. How are you?
I'm good. Making it a month into lockdown.
Yeah. Probably another month to go.
Exactly.
Oh, geez.
Yeah. Where are you from, Josh?
I live in Palos Verdes.
All right, nice.
Nice.
Yeah, I'm in Manhattan Beach, so not too far.
Oh yeah, yeah.
What do you
I've been to the Manhattan. I've been to the Manhattan Beach meetup a couple times.
All right, cool.
Yeah, we met too. I think we met at the Marina Del Rey one, actually, I think.
Oh yeah, yeah, yeah.
Yeah.
How's it going?
So, Jason, what do you do in real estate? Or Josh, I mean.
I just started investing this year, basically.
All right.
So I have single family home rental in Kansas City, Missouri. And then funny enough, I closed on 2 vacation rental cabins in the Smoky Mountains right when this all was all hitting. So
All right.
Oh, wow.
but
Where in the Smokies?
my cabins are in Pigeon Forge.
Oh, cool.
Yeah, they're
Nice.
like where it is. It's kind of in between Pigeon Forge and Gatlinburg.
Okay.
And luckily, it's still getting bookings. Not like I've lowered the prices. I've kind of done whatever I could. But for this month, I feel like I've covered at least my mortgage.
Oh, that's great.
So not too bad.
Yeah, that's great. A lot of people aren't doing that if their tenants aren't paying rent. So that's great you're doing that.
And my Kansas City place, luckily, so far has paid rent up till now. So
That's great.
so far, so good.
Nice.
Yeah.
Well, I know more people will keep coming in, but why don't we get started, and then we can kind of go from there. Let me share my screen here. Share screen. All right. So a little bit about myself, president of Break of Day Capital. I own a piece of 1,700 units, and I asset manage 17 million. I started a podcast with Kyle Mitchell. He does the passive income through multifamily real estate on Mondays with his wife Lolita, and we're doing Fridays, asset management Fridays. So we just started last week, but we've probably done about 18 interviews so far. And they're like 10, 12 minutes. They're pretty short. And we've had Neil Bawa, James Kandasamy on there, Brian Burke. So some big hitters, and it's really informative, no fluff. You know, you're really niche oriented. You know, we ask them a few questions about a particular idea in asset management, and then and that's it. So definitely check it out. I'm based here in Manhattan Beach, and I do deals in Phoenix and Tucson. Jay, why don't you introduce yourself?
Hi everyone, this is Jay. So I've been hosting this meetup with Gary for a year now, I think. This is our anniversary. April is when we started in 2019. And I've been working on real estate development deals in LA for a company called CIM Group. And apartment syndication is, I picked that up about a year and a half ago and started diving into it. Definitely very interesting type of investment strategy. So I'm glad you guys are here. And this is actually going to be my last meeting. And maybe Gary can make the introduction, but it's going to be Robbie who's going to be taking over going forward, because I'll be leaving the United States.
Well, we're definitely, you're definitely going to be missed, Jay. Too bad we can't do that over beers right now, but maybe in a couple months before you go, we'll be able to do that over beers. If you can actually check, some people are having some problems getting in, Jay. If you can check on Multifamily Masters, and Robbie, why don't you introduce yourself?
Sure. Hey guys, my name's Robbie Wu, if you can't read on the Zoom link. So yeah, super excited to take over. I'm actually a full-time software engineer, so I'm not a full-time real estate investor, but I'm looking to go in that direction. My wife and I started looking and learning all the power of passive income about a year ago. So we've been coming to these MFM events and a whole bunch of other conferences for about a year. And we decided to jump straight into multifamily investing and skip the whole single family and go straight into commercial multifamily. Definitely understand the power of passive income in multifamily and the power of networking and the MFM network. So I'm excited to take over and uphold this tradition of quality networking and content. Got big shoes to fill from Jay, but excited to get going.
All right, thanks for that, Robbie. All right. So we've got the multifamilymasters.com Facebook group. So if you haven't joined that yet, make sure you do. And then also Kyle and we have over 2,000 members, the passive income through multifamily real estate. Definitely enjoying that as well. Love to have you. Next virtual meetup is going to be Wednesday, May 20th at 5:30. And we'll also have our Phoenix group and our Long Beach group joining us. So that'll be with Kyle Mitchell. And I think it shows up as me, as Kyle Mitchell for my name. We share this Zoom, and then and Robbie will also be hosting it. Today it's we're going to walk you through a 128 unit case study, but it's definitely interactive. So if you have questions, you don't need to put it in the chat room or the Q&A. Just talk and just ask a question, and we'll address it right then and there, because we want to make it as much like a regular meetup as possible. Out of curiosity, maybe use the chat box to say where you're located and if you invest in today's market, if you thought it was a good deal. Let's see. All right, Robbie, how's that looking there? All right, chat room. All right, so now we're starting to see. So yeah, definitely feel free to network in that chat room as well. All right, so this is a property we saw this Kyle Mitchell and I in November. No, I mean we bought it in November. We saw this in June. One of our partners on the deal, he had worked with the agent before, and he sent him the deal off market, and it was going on market like the next day. And so what we did is we underwrote it that day. Oh, well, Kyle underwrote it. He texted me and said, we're going to Phoenix tomorrow. I'm like, all right. So we left at like 4 a.m. in the morning, got there around 9. We were the first ones to see it. And, we liked what we saw. We walked the comps, and on the 5-hour drive home, we, kind of tweaking our underwriting and put in an offer that day before it kind of, went full market, because, we didn't want to be in that, competitive environment where you're just bidding and bidding up. And I mean, I've never won a deal that way. And so this way we wanted to kind of grab it before it went full blown, and we were able to do that. Kind of walk through, this is what the property was called, the Casa, and overgrown bush in the front. You've got trees kind of were blocking the sign. You can't really tell from here, but when you're driving by, McDowell is a very busy street. It's just north of the airport, near a bunch of the different highways, not too far from downtown and Scottsdale, but not great signage, and the property was blocked. Now these pictures were taken by a professional photographer who was pulled from the brokers, so it looks perfect, and, it looks real glossy, but that's not necessarily the reality. But this was the interiors. So they did, I think, about 8 units upgrades. This obviously wasn't one of them. It's in decent condition. You can definitely rent this out, but a little bit of money can go a long way on this unit. So the opportunity is, branding. So La Casa is towards one demographic. And so what we did, we came up with a name called East 3434, more of like a hip urban name. And we were working on this well before we closed. Our property management company has in-house marketing and advertising. So we were working on the name with them. Actually, I was the one, they gave us, you know, a list of names, we were going back and forth, and I was the one that kind of came up with that one. The property management company that was currently in place, they're used to doing small properties. They don't have the infrastructure. When we were looking at the paperwork, a lot of the things were not adding up correctly. So for that, that screamed opportunity for us as well. There was little to no rent increases for a lot of the existing tenants. For the new tenants, they were pushing them up a little bit, but for the old tenants, they were definitely under market rents. Also limited amenities. They had the playground, the pool, and the laundry room. But what we're adding is a barbecue area, Amazon Dropbox area, a business center. So we're adding more amenities so we can get higher rent and better tenants. It's also in a growing submarket, so it's not too far from Scottsdale and Tempe. So it's a C-class market, but it's definitely turning into a B-class very fast. And actually, right down the street, we bought this for 118. Someone sold theirs. It's definitely a nicer property, but they sold for 173 a door a few months ago. So we feel really good about where we're at. And obviously we've got the value add. We'll kind of walk through that. Any questions with the opportunity? All right, I'll continue. So business plan, interior upgrades. I'm a big fan of having hardware on the cabinets. Just looks so much better. It's really cheap, and just visually, it looks really good. But also flooring, we'll change cabinet fronts if need be, and cabinets, countertops. Our property management company, they manage 16,000 units. So they have really good buying power. So we actually went to granite for our countertops. It wasn't in the initial plan, but the price was really good. So we ended up just going the extra mile for there. We're adding a dog run as well. Improve the lawn, roadside landscaping, fixing deferred maintenance. So for something like that, it's the angle stops for the plumbing. So instead of constantly paying for plumbing issues, we're just going ahead and fix all the angle stops. I mean, we had our in-house guy do it. You know, the angle stops maybe cost us, you know, a few $100s to buy that. Also with our AC units, we're doing some maintenance on that. So we're just not having those units go break down all the time. Also increased other income. So things like rugs, we increased. So I don't think there was any rugs before, and now you know, we're charging like $45 a unit. So that's, you know, $45 times, you know, it's going to take, you know, a year to get everyone up there, but times 128 units times 12 months, that's $69,000. And then if the cap rate here is 5%, so divided by 5, you're talking about increase of value of $1.382 million. I mean, that's a huge increase just on RUBS. We're also increasing rents to market. Obviously, we have, I mentioned our third-party property management company. They're great. You know, when we went in for our due diligence, they bring, you know, 10 people. We've got spread it up into 3 teams to look at all the units. They had 5 people in the leasing office, and they were going through all the leases. So they have a lot of depth in their team, which is great. So if we had, you know, we didn't like our maintenance guy and we had to let him go, but, you know, so they loan us someone else from another property. So it's nice to have a company that has a bench, you know. Expense management, and I'll go into that a little later. It was at 47% before we bought it. Right now it's about 42.7, but I think that's a little misleading because we weren't fully staffed, but we're definitely inching it lower. And our goal is I believe 41% after the first year. And then the rebranding, which I mentioned. Any questions with the business plan?
I have a quick question.
Yeah.
In terms of implementation, are you having, because you said that the property management company has good buying power to get, you know, the good deal on Granite. Are they overseeing a lot of these renovations? Especially since you guys are based here, obviously.
Yeah, so they're doing, they have a separate division that does all the rehab for us, or the bulk of it for the interior. Now we're doing some turns ourselves. If we don't need to change the flooring and the cabinets, our 2 maintenance guys that we have on full-time staff, they're the ones that are doing those. We actually stopped, you know, rehabbing the units, obviously, because we're in, you know, cash preservation mode. Our capex was 1.4 million, and maybe we spent, you know, 100,000 of that. So we're in great shape, but we're just gonna wait, you know, because we're not gonna, you know, increase the rents or anything like that. So we're just finished all of our rehab units, except the turns we'll do in-house, and just hold off on that for now. So as you can see here on the right, you'll see our rehab budget. So we're installing 90 washer dryer units, and we'll rehab about 71 of the units, the interiors, and that'll vary based on, you know, how many turns we'll do ourselves and whatnot. But that's, you know, we have a pretty sizable budget. Signage for rebranding, and you'll see that later. Landscaping, so you can just kind of read through the list. And we always have contingency here, and we always over budget as well, besides the contingency. Because some things are going to cost more. You're gonna change as you go along, and some things it's a little less. But you want to have plenty of room. You don't want to use your cash flow for your renovation budget. And so on the left, you could see where the rents were and where we're pushing them to. Obviously, we have a freeze on what we're doing right now as far as our rent growth, and even like renewing people at the same price, just because we want tenants in their place, and we'll worry about getting them out or raising the rents, you know, a few months from now when things stabilize. So our most important thing is maximum occupancy and people paying. So here you can see where the expense ratio was, the T12, which is the trailing 12, last 12 months. And our goal is 41%, and then year 2 is 36%. And part of that also is, you know, as we increase revenue, the expense, you know, if we can keep this expense the same, now that percentage goes down as well. But we also did, we had a Fannie Green loan. So we did some water conservation, changing out some of the faucets, putting aerators on them, and low flow toilets. So that'll help increase, and also some LED lighting as well on the exterior. So that's a savings to us. We're not focused on the lighting for the tenants, you know, because that's a saving to them. So we have to do with the loan. It's 15% water savings, 15% electrical savings. So we're focused on the savings that we will get. Any questions on the renovation? All right, move on. So here's our location. Most of you should know Maricopa County, which Phoenix is in, is #1 growing county in the US the last couple of years. 5th largest city. Tremendous population growth forecasted over the next 5 years, more than 50% over the US average. So that's why Kyle and I, he's the other asset manager, that's why we love Phoenix. But certainly before COVID happened, it was hard to find a deal. Prices have been skyrocketing, and you know, because we're not the only ones seeing the data, but you know, we're starting to see that soften quite a bit. We had to put, you know, a couple $100,000 of hard money down to get this place, and we're seeing that it was increasing from for the other deals that we were bidding on. So now that's kind of gone away, which is great. And, you know, we'll hopefully, we'll grab some deals before the end of the year. We Are Apartments. I like that website. And they show that Phoenix is going to need 150,000 new apartments by 2030. And that's not, that's separate from the new construction which isn't keeping up. And just across the street is a new charter school getting built, which is great for our tenants and our value. All right, so wins and challenges. So mentioned the charter school and the other property that sold down the street. And then we took over the property with 98% occupancy. I think we estimated for year one 78% economic occupancy. So the 98% doesn't include, you know, people that weren't paying rent, but there wasn't that much. So when we got the property, we had a lot more income than we expected, which was fantastic. Challenges, because it's not all you know, gravy. No matter what property you get, you're gonna face some challenges. Is parking. The spots are kind of narrow, and there just aren't enough of them. We talked to there's an office space next door, and they don't want to lease any parking to us. Obviously, we don't want anyone crossing the street because it's a very busy street. There's an empty lot next to us on the other side, and they haven't been willing to work with us on that either. So it's still a challenge that we face, and we may not be able to solve that problem, but it's something that we're dealing with. Also, some credit unworthy tenants. The property management company before us, they were stuffing the units. So that's why we had our 98% occupancy. They were taking people that maybe didn't have 2.5 times income for the rental income that we needed. And we found that out when we were doing the lease audit during due diligence. So we knew that going in, and we haven't been able to turn everyone. You know, we only bought it in November, and now here we are with COVID. So we are facing a little bit of that problem now with some of these tenants. So up to now, we've collected 79% of the income that we've done in the past, which is about the average that I'm hearing. We definitely feel that's going to keep creeping up as the month goes on and people get their stimulus checks. But it's, you know, next month we feel that number is going to go down, obviously, as people have been unemployed longer and they're going to hold on to their money and use that towards groceries or other things. But our Tucson property is actually, we're basically at 100% of rental income. And that's a lower price point. That price point is about $625 a unit. So it's easier for people to pay their own bills and be able to pay that rent. And then permits. We started on the washer dryer permits beginning of October, and the property management company is like, why are you starting so early? This was, I guess, about 6 weeks before we closed, and we wanted that ready to go when we closed, but by the time we closed, you know, we're still waiting. Then we ran into the holidays. I mean, it took us a really long time, and we finally got it maybe about 2 months ago. And so we've done maybe 5 washer dryers so far, but that's something that was a lot slower than anticipated. And we were renovating units and not able to put the washer dryers in yet. Any questions with the wins and challenges? All right. So here's a look of the interior now. We've got the tile backsplash, the granite countertops, nice shaker doors, the handles, stainless steel appliances. We actually dialed back the backsplash. We're not doing the backsplash anymore. after, you know, kind of going back to the comps and seeing what they're getting, and we just felt, you know, for the, I guess it was about, you know, $550 for the backsplash. It just wasn't worth it. It just wasn't needed. So, you know, if we could save that on 50 units, you know, maybe we could turn a few more units and get a premium rent. But you know, as we're going along, it's okay to pivot, and that's something that we did with the backsplash. As you can see, we took a closet here and put in the stackable washer dryer. And this is a 3-story building, so we had to do some plumbing work. It costs a little bit more. You're talking maybe about $4,200 to get that installed and pay for the washer dryer, but you're getting a $50 to $75 rent bump for the washer dryer. Here you could, on the left, you see the bathroom, and then we have an accent wall, and we also do that in the family room. This is one of the bedrooms too. Nice white baseboards as well. Really pops. It's real nice. Any questions on this slide? All right, let's go to the next. Whoop. So another big thing that we did was a leasing office. I think we budgeted about 20,000. I think it was a little less. When you walked in on the left, there used to be someone working there, and behind it is our alarm system. So we covered the alarm system, and we put a nice seating area there. So, you know, that first impression is so important. So when you come in the leasing office, we have this front. We have the leasing assistant's desk. You can see back there. The leasing manager's office is to the left, and then we have a business center, which is on the right. So, you know, it's not much of a business center. We bought 2 computers. You don't. I took the picture before you could see the computers, but it's still useful to the tenants. And that area used to be kind of like a mishmash of different things. So we kind of sealed it off and kind of beautified that leasing office. And we also painted the front of that leasing office too. So, and better signage. When you drove through our property, it was hard to find the leasing office. So as you can see, new signage here. We cleared the front brush, which was kind of ugly and you couldn't see the property. So we planted a bougainvillea, nice new signage here, big banners. And we took out the trees that were blocking it. So with all that traffic, you could see it from both ways. The banner to the right, I mean, that is a monster. It's got to be, I don't know, maybe 20 by 15 feet. And we have it on both buildings. And what we did is when Kyle and I were out there, we noticed that at night it wasn't lit up. So we had them put lighting there. Probably cost like $500, but it was still worth it for people to see it all the time, you know, to see those big banners. And, you know, we're from the walk-in traffic, we were converting a lot of those people into leases. So a huge payoff. All right, let's open it up for questions. Anyone? All right. Well, I wasn't expecting this to go so fast. All right. If you have questions, definitely unmute yourself. Let's see here. Oh, I think we can. All right. Let me see if I can unmute you. Here we go. Let's see. Let's see here. Sorry. I'm going to stop the share. All right. Can you guys unmute yourself now or no?
Yes.
Yes.
All right, great. All right, any questions?
Yes, I may have missed it, but what is your economic vacancy for this month?
That's 21% right now, and it's getting smaller every day. So we have access, to the Yardi. We get our weekly reports, but we check it on a daily basis and see where we're going. We talk to our property manager every day via email, and whether they hear of a new program or we hear of a new program. We're trying to work with our tenants. What we did, we've waived the credit card fee of 3%. Tenants can also use their deposit. Not a big deposit, it ranges from 300 to 600, but they can use that. But they need to refurbish that by August 1st. And we're just communicating to everyone that hasn't paid on a daily basis to see where they're at, see what they need to make it as easy as possible to help to work with them, and for us to get paid, and for them to be able to make it through these tough times as well.
Yeah. Yeah, between economic and physical, we're at a 25% vacancy on our property.
All right.
So we're about in the same area you are.
Yeah. Yeah, it seems to be that's about the average nationwide. C class is getting squeezed a little bit now, just because those are the people that are getting let go. But A class is going to start feeling it in the next couple months as people start training down from the higher price stuff.
Yeah.
So we got a question here. Does a rent audit usually show uncredit-worthy tenants prior to sale? Good question. If you have a good due diligence team, yes, you'll find that. But they went through every single lease, 128 leases, and checking that. So that's how we're able to do that. It's you've got to be checking everything when you're looking at a property, because you just don't know, and that includes all the paperwork involved. How long is the laundry lease? And can you install washer dryers? It might say in your laundry lease that you can. So you've got to look at everything.
Is that a team that you hire to do the due diligence? Because I heard you say a due diligence team.
Yeah. So we use our property management company, Shelton Cook, to do that. We paid a small fee. It might have been as little as $1,500. I mean, it certainly didn't cover their cost, but obviously they're getting the money from us hiring them. But in other areas, you might not have a property management team that's got so many people that can come and help and do that. And so I know in Tucson, we paid a guy, I think $40 a unit to go through everything, and then we did the lease audit. I know in Dallas-Fort Worth, there's a company, Brian Amos has, and some other companies as well, that they'll go in and do the whole thing. Also, our third-party property management company had a guy that he helps check all the major like AC units and all that other stuff that like the plumbing, all that stuff. We brought in vendors, and he kind of manages that piece as well. So he'll go through everything, and really by the end of the day, we had a really good feel of where we were. And this was access before we signed the contract. Because we were going hard, we wanted access, and we were able to know really after day one where we stood. We felt pretty good about that. We did negotiate a little something as we were kind of going along. We saw some things, but we were able to work it out. I mean, we thought we fell out of contract twice with this deal. It was hairy up and even to the last day we were supposed to close. Our team was on site, and we haven't recorded yet, and they found a down unit, meaning that it wasn't unoccupied. It had a mold issue, and they were supposed to repair that. And that could be a $20,000 cost. And here we are, 200 hard, and negotiating with the seller, who is not, a really easy to work with person, and trying to fix this before, 5 p.m. basically when we had to close. And if we didn't close that day, we could have, potentially lost $200,000. So pretty hairy situation, but we were able to work it out.
How did you find that molding issue? The mold?
Because our team was on site, ready to take over, and I believe the other property management company mentioned it, and so our team called us, we called our lawyer, we called the broker, we called the seller. I mean, it was back and forth craziness for a couple hours. All right. Can you give us an overview or a brief walkthrough of how a multifamily process works from offer to closing contract as opposed to single family? So the first thing we do is we submit an LOI, a letter of intent. And in there, we have some basic points, purchase price, amount of time for due diligence, how much money we're going to put down, how much money is going to go hard, meaning, it's, you're committed basically to releasing that money, extensions. I think we had 2 30-day extensions in that. And then once the letter of intent is signed, then you have your lawyers kind of turn that into a contract, and it should be fairly easy. But in our case, their seller never gave their lawyer the letter of intent. So when they sent us the contract, it was completely different. It was like none of the terms that we agreed to, and we're like, what the hell? Like, this is ridiculous. So obviously we call the broker and say, hey, you've got to straighten this out. We went back and forth for a couple of weeks, and this was a longer process than it should have been. And again, we thought this deal was dead in the water, and eventually they came around and kind of went back to the terms that we had. But it was not necessarily a good faith seller. That makes things a lot more stressful. What does your loan stack look like on the property? So another interesting story too, because when we were underwriting this, this is in August. We're raising money, or September. August, we were going to have our webinar, and I think we're close to about 4%, close to about 80% financing, and we're heading into the fourth quarter, and Fannie froze their lending because they had maxed out on what they could loan, and rates jumped up quite a bit, and it took away our buffer. So I think for our underwriting, we had at maybe like a 4.4, and but we were quoted closer to 4, and so we had this buffer, and we had it at maybe like 76%, and as our buffer, and the loans proceeds went down to 76%. So what we did, we actually canceled our webinar and said, hey, we need to see how the lending environment's going to shake out before we can move forward, because we didn't want to change terms on our investors. So after a couple weeks, Fannie reopened, loan rates went down a little bit, and we had our buffer back, and we were expecting probably closer to about 4.35, and we ended up closing at about 4.2, and I believe about 76, 77% of loan proceeds. So at the end of the day, we were very happy with what we got. And then we raised 5.7 million on this deal, and we purchased it for 5.15 million. Let's see some other questions here.
Hi, I had a question as well.
Yeah.
I was wondering, for your passive investors, what were the minimums and the returns for them? And what was the structure that you had in place for passive investors?
Yeah, great question. So we did a 70-30 split. with 8 pref. And but the first year, the pref, we were estimating about 5.5%, and then the second year about 8, and then as we're doing our renovation and increasing rents, then it goes to like a 9.5, and onward and upward as we continue. IO is critical in boosting those pref returns, and we ended up getting I believe 5 years, which really helped. But the IO definitely plays a factor in that, and you really don't know till like right before you're closing. So we rather under promise and over deliver, so that investors are happy.
Awesome. And what was the minimum return for investors?
Okay, so the minimum investment was 50,000, and it was a 506B, so we can have up to 35 sophisticated investors, and the rest had to be accredited. Our estimates were, I think, a 15.24% IRR and about an 8% cash on cash.
Awesome. Thank you.
And then we obviously hope to beat those estimates, but again, we'd rather be conservative and overhit our mark. And our sale price, I mentioned the property down the street was sold at 173. Our sale price after a 5-year hold is 168. Again, that property is nicer, but we feel pretty good knowing that, hey, we've got many years to go. Certainly, the period that we're in now, we're it slows everything down for 6 months, and we're kind of going backwards. But this is a long-term investment, and we're going to be we're in really good shape. We have very well capitalized, and you deal with the blip, and then you're able to kind of when things start ramping up again, we can start picking up. And we did a stress test, and we don't have us really ramping up until January. We have things kind of going down and then kind of going back up to where we were in the fall, but then kind of really starting to push rent again in January. So we have a slower lead time. And our stress test, I think we can survive at 60% economic occupancy. So that's a really good safety margin.
Awesome. And I missed the first part. I was having trouble logging in. What was the size of the property?
128 units.
128. Awesome. Okay.
Yeah.
Awesome. Thank you.
Sure. All right, we got some more questions here. And yeah, sorry about the login. We're having problems with the Zoom webinar, so that we switched to this. All right. So Daniel B asked, sounds like you're happy with your team. How did you identify them for this particular property? Quite honestly, we in Phoenix, we weren't looking to use them in the beginning when we were looking at properties. We were concerned that they were too big, and we were working with someone else, and this guy from this company, he was doing a lot of budgets for us, because every time we like a property and we're putting an offer in, we'll do a budget, and we want them to do a pro forma as well, so that we could see, hey, are we on the same page? We talked through the renovation budget, and there was one time that we were closing in on a deal, and he kind of mailed it in as far as the pro forma, and at that point we're like, we can't work with this guy anymore. We weren't happy, and this company that we're working with now, they managed our Tucson property, and we've been very happy with them. So we started working with them, and we've been very pleased. Considering they have over 16,000 units, we never felt like we were just a number. They've always, we've always had access to the owner if need be, and we love their support team. So we've been very happy. Given the size, any parameters you were able to negotiate with them for this type of property, 3% is the typical asset management fee. There's more room on negotiating on a smaller property when the fees are higher. And then we also pay salary to the staff as well. That, you know, and the benefits that comes out of our costs as well. So there was a question: do we have a catch up with the pref? Yes. So if you only get 5.5% in year one, you'll get that first before the sponsors see any money. So all the investors, and I'm an investor myself, all the sponsors invested money. You'll see 100% return of your money. You'll get the pref first, then we'll do the 70-30 split with the sponsors. So we need to perform well in order for us to get paid. Do you have any Section 8 tenants, and does it take a lot of paperwork for landlords to accept Section 8? Good question. So we did have a couple. We actually have been ramping that up a little bit. There's a website, I think it's gosection8.com, and we just took a tenant today. We took a Section 8 tenant the other day. You've got to be careful, obviously, if you're trying to improve your tenant mix. You know, you want to, you know, depending upon where you're going, you don't want to have too many Section 8 tenants. But in a time like now, when we want maximum occupancy, maximum cash flow, we're willing to take on a few more. But obviously, you need to make sure that you know, you're just being very diligent about who you're accepting. But the thing you can reach out on the Go Section 8 website. You can kind of see everyone, and you reach out to people that you want, or just you can advertise on that site. We've been proactive on that. We've actually been proactive on leasing ourselves, which has helped. I mean, our property management does their job, but there are things that we can do on our end to help increase our occupancy. All right, so what are the fees the GP side takes? Good question. I think we took a 1% acquisition fee on this deal, and then we take a 2% asset management fee. So 2% is pretty standard on an acquisition fee. You'll maybe see 2 to 3% depending upon the size of the deal. And then we don't have any fees on disposition or refinancing. You know, we are aligned with our investors. We don't want a fee just to sell the property. We sell it because it makes sense for our investors and for us. All right. How many were involved on the GP side, and how do you guys determine the split? So we had 6 people on the GP side. And basically, obviously you can't get paid on how much you raise, but we base it on factors like, okay, who found the deal, net worth and liquidity played a role, who's the asset manager, who's doing this and who's doing that. And so we were able to come to an agreement on the split. But yeah, you want to figure that out up front, and but be wary of, you know, people getting paid for how much they pay, because that's obviously illegal. So just something to note for you future sponsors out there. So how many sponsors? What were the roles? So Kyle and I are we're the asset managers. All the other sponsors are on the calls when we have our weekly call, but everything goes through Kyle and I. So we present out as like a board of directors. So if they have a question, they will feed it through us, and we can ask our asset manager, and then we send them all the reports that they want to see. And you know, at times we'll have a conference call when we're setting up the deal. Someone helped put together the marketing package. 3 of us did the webinar for the property. So everyone played a part, and everyone still plays a part. We share ideas and best practices, particularly now. And, you know, we want to see what other people are doing at their other properties. So, you know, we'll get kind of, whether it's email or call, and kind of share that, so that we can maximize our value for our investors. All right, I think that's all the questions on the chat. Anything else from anyone else?
With all the COVID stuff, have you started to see any kind of cap rate changes in terms of affecting your valuation for when you exit, and also looking for additional deals?
You know, what we've seen so far is a softening of terms. So no hard money, able to extend longer. But we haven't seen the cap rate move, maybe a tiny bit, but not that much. And we're deals that we were interested in, or we were like the second best offer or the third best offer, are starting to come back around to us. But not at the price that we jump at right now. We also had a deal, we were very close to a deal, I guess towards the end of March, and that fell out because the seller took it off the market, because he knew we were going to just keep, you know, holding it until, you know, obviously if NOI was going down, we'd want, you know, a discount, and we would kind of move it along slowly. So they're going to bring it back to market, you know, down the road. But yeah, we're starting to see some deals. We got a portfolio deal that got sent to us this week. You know, it's got to have a discount, and a good discount for us. We're long-term investors, so if we see something that works now, we're gonna jump. We're not gonna wait. I know a few people out there have been saying, "Oh, I just want to kind of wait 3 months." We'll jump on an opportunity now if we like it, if it makes sense. We know our markets really well. We don't go across the nation and look at everything. We're really focused on Phoenix and Tucson, a little bit in DFW. I've got 4 deals there as a passive and as a KP, not as a sponsor, but I've got some boots on the ground there. But Phoenix and Tucson is, you know, Kyle and I are out there all the time, obviously, except for the last month, and we know our brokers, we know the market, so we're confident if we see a deal, you know, we know if it makes sense or not.
Thank you.
Sure. Daisy asked, do we live in Arizona? No, I'm here in LA. My business partner is in LA as well. He's actually thinking about moving to Phoenix in September. I think he's at 75% chance that he's going. So, because we want to do more deals. So, you know, that'll help us. But you know, certainly we have good relationships, and like I said, we're out there typically 3 times a month. We host a meetup out there on a regular basis. But it'll help. But you know, for now, we're here based in LA. It's a 5-hour drive, or you know, when we take a flight, it's an hour flight.
Very cool. Thank you for sharing. I was asking because my fiance and I are actually looking to move to Texas for the same reason,
All right.
to be more boots on the ground. So I was wondering how far you were. But
Nice.
awesome. Thank you.
Yeah. Kyle McKinney asked, what has been the response from your investors on new deals? Are they still in the game and wanting to invest in this current environment? I would say probably about, you know, we did a poll, and I'd say about 60% were interested in investing, and 40% are kind of wait and see. You know, I'd love to have, you know, all of the investors want to, you know, be gung-ho for a deal, but they're kind of, you know, they're going to see what we put out there and see how things are shaping up with their, you know, personal finances, and kind of go from there. Do you know if people can still receive business credit? Zach, what do you mean by that? Yeah, let me unmute you. Zach, what did you mean by can they still receive business credit?
Can you hear me? Can you hear me?
Really low. Can you speak up?
Hold on, let me bring my mic up. Can you hear me now?
Yeah.
All right, cool. So, I've been talking to somebody who's been giving out business credit, but just like not really business loans, but like business credit. Do you know what I mean? Like, I can't really explain it. I was just, if you don't know, then it's okay.
All right.
All right.
Well, I'll speak to the grants out there. So our property management company has over 500 employees, so we can't get the PPP. We did apply for the EIDL for our LLC that owns the property, and we're looking at the different stuff that comes online as far as the loans and the grants. We are not going to do forbearance. We've heard a lot of negative stuff. If you do go to forbearance, that will be on your record. And for us, there really is no reason. We have, again, lots of capital. Even our lender, they are coming out with a program because they don't want to be the one lender that goes to Fannie Mae with forbearance. So it was interesting. You still have to repay them, but we're working with them on something right now. So we'll see, and we'll keep, there's more programs that come online and for our tenants and potentially for our property as well. So we're constantly staying abreast. I've probably been on 20 webinars in the last, couple weeks, and, just reading everything I can and just sharing ideas. And I appreciate all of you that are posting and sharing things that you've learned as well, because, we're all just helping each other. All right, any other question? Kyle McKinney, how often do you communicate with your investors? What investor management software do you use? So we do have an investor portal called Investor Deal Room. That's one of the less expensive software platforms out there. We don't use it that much to communicate. Quite honestly, we have the K1s up there. We use it for the investors when they came on board. The reason why is through that software is nice because we can separate everyone. All the sponsors can manage their own investors, and that's what we still want to do. So what we'll do, Kyle and I will create a template and then share it with the other sponsors, and then they can share it with their investors so that they have their that communication. And right now we've been communicating with them twice a month. And then this month actually will be 3 times because we're going to do a webinar meeting as well. And this way everyone can answer any questions that they might have that they haven't. But we're really over communicative. So no one's been reaching out and saying, hey, what's this going on? What's that? What's happening there? Because we're giving them all the information that they need. The only communication that I've been receiving is thank you. We really appreciate what you're doing. You're doing a great job, stuff like that. So we give them all the tools, all the information. We're 100% transparent, so that it frees me up to do my other, everything that I need to be doing. All right, Daisy asks, how do you build your investor base? Well, this is one way. I've definitely gotten some investors from my meetup. We do our webinars. I go to a lot of conferences. At conferences, I can go through 75, 100 business cards at a conference. And it's not me just talking to someone and just like quickly going on to someone else. I'd rather have a more meaningful conversation with someone and have 25 good connections than 75 bad connections. And when someone just hands me their card and we don't have a conversation, I'm kind of gonna, not throw it out, but push it to the side. Like I'm not gonna, that's not a valued contact to me. So I always have a pen with me too, and I jot down notes on that business card. And you have to cultivate that list. I do a monthly newsletter. I I try to reach out and do calls as well. I am not great at that. I need to keep getting better with cultivating my investor base, but you've got to start somewhere, Daisy. And yeah, just keep, joining groups. We've got that passive income through multifamily real estate group, and getting yourself out there. So, webinars are a great way, considering you can't go to any meetups and conferences right now. All right. Well, I appreciate you guys coming out tonight and joining us. May 20th will be the next time. But yeah, check out the podcast, Asset Management Fridays, and feel free to reach out anytime if you want to talk real estate or have any questions. And I look, hopefully you guys stay healthy and well, and are staying positive. And I look forward to chatting with you guys soon. Have a good night.
Thank you.
All right, take care.
Thank you.